5 best stocks to invest in for the next 10 years. The best long-term stocks are growing businesses that deliver steady returns. To find them, you need to understand the metrics that provide solid evidence of dependable long-term performance. Things like regularly outperforming the S&P 500 and avoiding the big drops that high-flying stocks tend to see over the short term. In this video, I'll show you the best stocks to invest in for the next decade. You'll see a list of 5 stocks that can provide you with a high-quality return on investment while providing a long-term growth opportunity. I'll also show you an easy way to diversify your portfolio using just 2 types of stocks. Long-term investors ignore the churning, short-term rise and fall of stock markets. Rather than getting caught up in the drama, they buy stable company shares with reliable performance measured in years or even decades. Now let's get to my list of the 5 best stocks to buy now and hold for the next 10 years. Number 1. Mastercard. Mastercard is one of the world's largest payment processors. It has grown annual earnings by nearly 20% over the last 5 years. Analysts expect growth to continue with 22.8% yearly earnings per share EPS gains. Mastercard is about 22% below its early 2021 all-time high. The forward price-to-earnings ratio PE of 24.8 is justified, given the stock's impressive growth rate. It is also one of the cheapest valuations in terms of PE the stock has seen in a while, as it has ranged between 29 and 62 over the last 5 years. In alignment with its growth, Mastercard has delivered an average annual price appreciation that's nearly 7 percentage points over the performance of the S&P 500 over the last 5 years. Number 2. Amazon. For years, Amazon seemed invincible, an e-commerce giant that made other companies shiver when it muscled into their markets. It helped Amazon's stock increase into the 4-digit territory, and Amazon's earnings reports often delight investors. Amazon's profits have lagged, and the company has long prioritized investing in long-term growth over making short-term profits. However, as the company matures, management seems to recognize that some costs have spun out of control, and that even a company that prizes experimentation can do too much of it. In the last few months, Amazon has shut down Amazon Care, its telehealth and in-person healthcare businesses, and Scout, a delivery robot. And reports just came out that management plans to lay off 10,000 corporate workers in divisions including Alexa and other devices, retail, and human resources. That should help give the bottom line a boost. Number 3. Apple. Apple is the largest US public company by market capitalization and needs no introduction. It boasts the strongest stock performance on our list over the last 5 years, outpacing the S&P 500 by more than 22% per year. The company has seen average solid DPS growth of 22.3% over the last several years, although this rate is expected to drop to 9.5% over the next half-decade. That represents the lowest expected forward earnings growth on our list. The stock is trading 14% below its 52-week high at a forward PE of 24.4. This is a decent entry point for the stock. The PE range over the last 5 years is 12 to 44. The dividend yield, which is a financial ratio that measures the annual value of dividends received relative to the market value per share, is a modest 0.6%, while the shareholder yield, which is how much money shareholders receive from a company, is an impressive 4%, as the company has been working hard to reduce the number of shares outstanding. Number 4. Spotify. Spotify Technology SA is a Sweden-based audio streaming and media service. Spotify Technology SA has a monthly active user base of over 400 million and intends to surpass the 1 billion level by the end of this decade. The company also focuses on keeping the churn rate low. The churn rate is the rate at which customers stop doing business with a company over a given period to retain customers. The current churn rate is around 4% because of the user-friendly interface and highly engaging and well-created content. Recently, Spotify Technology completed the acquisition of Findaway, which operates throughout the audiobook industry. Spotify Technology singled out audiobooks as a critical sector for growth and rising client lifetime value. Additionally, the company revealed that it had acquired Sonantic, a dynamic AI speech platform that generates voices from the text. These acquisitions align with the company's target of increasing average revenue per user by 4 times by 2030. The majority of analysts have a favorable long-term outlook on Spotify technology stock due to the higher demand for audio streaming services moving forward and an advertising opportunity related to the industry that is still in its beginning. Number 5. Tesla Inc. Tesla is among the best long-term stocks capitalizing on the shift from gasoline-powered vehicles to EVs. Tesla is spearheading the EV revolution through its lineup of vehicles catering to the demand of the residential and commercial consumer base. Tesla is on a solid growth trajectory as it reported an increase in EV deliveries by 42.5%. While year-on-year growth rates are rates of change expressed over the corresponding period month or quarter in relation to the frequency of the data of the previous year to 343,830 vehicles during Q3 2022. The company has also vertically integrated its offerings to provide consumers with the best possible battery technology. Some predictions indicate that Tesla has the potential to develop its businesses to compete with the leader in AI technology, NVIDIA Corporation, and gain a more significant market share in the coming years. So there you have it, guys. If you enjoyed watching this video and learned something new, don't forget to smash the like button and subscribe to be the first to watch the following videos and for more finance news, guides, and updates. Thanks for watching.